Well, Max Boonen, co-founder of B2C2, the UK-based cryptocurrency market-making firm. Max has been a friend of the Scoop for a while. This is his second time on the show. I'm really excited to talk to Max because they have sort of been firing on all cylinders since March 12th, 13th event with the big Bitcoin drop, and have been quoting prices, trading electronically virtually all day long. During that price downturn, Max was hunkered down at an undisclosed location with some of his colleagues in your living room, right?
Precisely, yes.
Yeah, so what was that like? So you guys were all there. Bitcoin had been sanguine for a couple weeks as, you know, equity markets were in turmoil here and in Europe and abroad. And then March 12th, 13 happened. What was it like to be with all of your colleagues during this quarantine in your living room as a trading firm?
Well, we were very lucky because, people had started isolating and working from home with the virus, but for a long time we had planned a bit of an offsite, and so that we were actually undergoing that offsite with the trading team, and so they would happen to be working from my place here, and I think that if had we been separately, all on our side, I think it would have been quite different, because it's very difficult to manage a trading team in a remote fashion, because things need to happen immediately. That's something you find it difficult to do when you're remote.
It's interesting because that's the exact problem I'm hearing in the fixed income and corporate bond world, where you have a system where voice-based communication and sharing of information is very important and done on a physical basis. And so when you don't have your traders all there in the same spot, that process is then made more difficult. And it's still even important in crypto. Now that everyone's back to where their homes are, what's it been like as a market-making firm, completely being separate from one another? What things are more difficult in that trading process?
So there's two things. On the one hand, we were electronic from the get-go. It wasn't our first rodeo. We started out in 2013. That's when the building blocks of B2C2 were put together, and then as a firm started hiring people in 2015. So we went through a lot of events that were quite dramatic in nature, and and from the very beginning, because initially it was just two guys in a garage, things had to take care of themselves. So the systems have always been designed such that they could function with no human intervention. So thankfully that's part of the philosophy here. But on the other hand, what you find is that in electronic trading, even though the machine expands its remit to encompass more and more functions, and there's less and less that needs to be done by human beings, you find that work expands to fill the gap. Anything that's done by the machine, well, what humans end up doing is just whatever's left over. And so that's I guess part of the challenge, is that it doesn't matter how much you think you're going to be able to automate. You think, well, there's that painful process that we have to do. Let's say every time there's a new future contract that comes out, let's say every week on OKX, every quarter on BitMEX, you think, well, let's automate that so that we don't even need to type in the new specifications of the next contract. Well, you automate that. Well, next thing you know is that there's other stuff that's not been automated, and that becomes 100% of what you have to do now. So the competitive dynamics of the industry are such that even though when you do electronic trading, the only way to do it is that there needs to be very little human intervention, human beings are still at it 24/7.
So what has been some aspects of what humans are doing that is more difficult now?
Sorry, say again?
So what's more difficult now for on the human side of things?
Well, I think one of the things that that a lot of people learn the hard way on the 12th and the 13th is that collateral management is one of them. You know, you've got a lot of strategies that rely on let's say infinite money, or the idea that if you do a relative value strategy, you buy some contract, you sell another, you know, you're hoping to capture small price differences. When the market moves 50%, you know, you think you're not losing money or making money, you've just captured some sort of, let's say, risk-free profit. But the problem is that in reality, on one platform, you've got a very high profit, and on the other platform, you're losing money by the second. And you've got to manage the collateral that you have on those platforms to be able to maintain those positions. And what can happen is that if you're not, you know, if you become liquidated on one platform because you haven't been able to sustain that position, now suddenly, you know, you were thinking, well, you know, I'm long $1 million here, I'm short $1 million there. Overall, I'm delta neutral. I have no exposure to price moves. Well, now you're either long or short $1 million, and that can really, you know, that can wipe out your profit multiple times over. You know, you made maybe, I don't know, 0.1% on your relative value trade, and suddenly, you know, you're long and the market's moving 10% per minute. That's and you reported on that, right? You reported on a firm that had you know, quite a profitable run, but the fact that they got liquidated on a well-known platform, and that wiped out 50% of the firm's capital. That can happen just like that. So collateral management is a very important thing that people tend to take for granted, especially the more electronic a firm is. You know, the well-known high-frequency trading firms that operate in conventional markets, they tend to sort of abstract away that stuff. They let that be dealt with by either a very small team on their side that's not prestigious, that because they don't make the money, right? So it's like a backwater, or they have a prime broker, they have a clearing firm that they use, and they tend not to worry about so much the funding implication of the activity that they have. But those effects manifest themselves at the worst time possible.
Mm-hmm. And what about, one thing that's sort of been in the news, and I think Bloomberg's done a good job covering this, is the impact of traders working remotely and then having to rely on their infrastructure that they set up at home, right? And so then there's a question of whether or not the connection is as good and whether or not latency is as good. And we talked about it before, having traders separate means you're not necessarily responding to things as quickly. So let's focus on latency first. Getting to the market and seeing the market from your undisclosed living room right now, or wherever you're sitting in your house, how does that work? And is there, are you experiencing any latency issues?
Well, thankfully, I've got a very good connection here, but I'm thinking of my colleagues that are just, you know, working from home because of the virus, and they probably have, especially if they're in the US, they're going to have a shitty connection, probably with Comcast or something, right? And the thing is
that's
that
what I'm dealing with.
If your latencies,
terrible.
if your latencies are impacted by where you are physically, that's no way to run an electronic trading firm. So you find that the algorithms anyway, they're gonna work on quote unquote collocated servers wherever they need to be, or pseudo collocated. They're gonna talk to one another without speaking to the mothership, and so that's not a problem. The only thing is that you're gonna be monitoring your systems via some sort of user interface, and it is a challenge to, you know, you've got a big fire hose of data that, I'm sorry if there's a bit of a, it's very light here because there's a nice sunset here on my side. Anyway, you've got a big fire hose of data. It's a terrible way to live. That big fire hose of data, you can't send it directly to your remote machines. In fact, even within your systems, when you become more sophisticated, you start paying for specific connectivity that's going to be on a tiered basis. So perhaps you've got some less important data, but there's more of it. You're going to send it through the normal public internet. And then there's some more latency sensitive data that you're going to send via different channels. And we know, from the the conventional markets that people use microwave towers, people use even shortwave. That's quite a novelty. I think that's people have started really using that a year and a half ago. Shortwave radio, so that they can send data, bouncing off the atmosphere between, over, let's say, the Pacific Ocean. So that's sort of the next level after microwave towers, because it doesn't depend on a straight line. Anyway, all those different connectivity options, they have a different cost, and the cost usually comes with bandwidth. I mean, for a certain bandwidth, you're going to have to pay this much. And so your fastest link in terms of latency is not going to be the highest bandwidth one. So all throughout your infrastructure, you have to manage the sort of, what types of data do you push through different links, and certainly the sort of last mile between your electronic systems and the user interface that traders see in the office or at home. It can't be relying on all those extremely expensive connectivity options. So it's naturally something that on the back end is downsampled, and if order books tick 100 times a second, there's no need for a trader to see that. So if the books update twice a second, that's roughly as fast as you and I can see anyway.
No, that's interesting. So are you seeing any impact on liquidity across the market as a result of this sort of disbursement of folks?
Well, definitely. I don't know if it's due to the dispersion, but I think it's quite clear that in the market, liquidity has receded a little bit in the past 2 weeks. I think it's been due, one, to the turmoil in risk markets, generally speaking, the S&P 500 and everything, but also it's due to the dramatic move on the 12th and the 13th. I think some people were badly hurt and had to retreat a little bit and lick their wounds, which is understandable. Not everyone is set up to handle such a move in a good way. If you were, good for you, but it's even very well known and strong firms like 0.72, and I'm talking about the conventional sides, 0.72, Bridgewater. Those guys have come out and said that they experienced some losses. Nothing major in most cases, but it's the fact that you may have had a tough time this month doesn't mean that you did anything wrong. Sometimes the market are just not favorable. When it comes to electronic market making firms, obviously they've been more favorable just because of the high volatility. You find that it's more sometimes of quant strategies that have had a bit of a hard time.
Well, let's get into that, because I think when you think about volatility as a high frequency trader or an electronic trading firm, you can best think of it as a wave, right? If you're a surfer, you don't want a monsoon, but you do want, that nice wave. And for traders, it's the same thing. More volatility, wider spreads, more profit opportunity. But too much volatility can be dangerous and risky. What's the volatility like in the crypto market, and is it at a favorable level for folks like you to make a lot of money?
There was a bit of an echo, which I turned off here. Thanks for the question. The volatility at the moment I think is quite Goldilocks. Back in 2015, 16, I think in some conventional markets, people were saying, well, there's too much volatility now. It's difficult to make money, and people were, some commentators were making fun of that, because it's like to some people there's never a good level of volatility. Volatility is subdued, people say, well, it's difficult to make money because markets don't move. Then suddenly there's a bit of volatility, and people say, well, it's not the right kind of volatility. I think that's usually just people maybe that are lagging behind a little bit in terms of their strategies, because in my opinion, the volatility that we have right now in the market is very good. Of course, you're going to have more P&L volatility. It's possible that firms that normally never make money on a daily basis, it's possible they have a loss, a couple of days in the week. But overall, on average, any market-making firm should be making a lot of money now.
So what are volumes looking like for B2C2 relative to early February, late January?
Oh, we had a record day ever that was on the 13th. Yeah, the 12th was a big day, but it's really when the market touched around $4,000 that a lot of people they reassess their view. They form new views. You've got people they wanted to be short, some people were long, et cetera. The market moves, and everyone reassesses what they think of Bitcoin, and that's where you got the big volume. Because in order to have a market, you need to have a diversity of views such that people want to meet in the middle and transact. And that's what you see anytime there's a major repricing in any asset class, is that a lot of people think it's overdone. A lot of people think there's more room to go. And they trade against one another. And middlemen like B2C2, that's when they make all the money.
Do you think there's more of a desire from larger whales or larger institutions when panic like that sets into the market to go to maybe a non-electronic platform because they want to talk to someone over the phone to move in size, or are they still coming to you, but maybe trying to engage in a more hybrid manner?
So the record day that we had, the vast majority of the volume was electronic, and I think even more so than on a normal day, because on a normal day you're going to have some voice trades that we have a team for that. People want to speak to a human being, they pick up the phone or speak on some chat app, and that's what it is, and you have to provide a service. Of course, I prefer when everything is electronic, and on the big record day, the share of electronic trading was even higher than it normally is. I think back in the day, maybe when there was a big move, people want to be able to express some large views, and in order to find enough liquidity, they need to speak to someone on the phone who's going to intermediate between two well-known whales, let's say, who have opposite views. I don't think that's the case anymore, because the crypto market has become a lot more liquid, and and a lot of that liquidity can be accessed electronically. So I don't think that nowadays, even if you want to move millions of dollars of Bitcoin, you necessarily need to speak to someone on the phone. And we had people electronically, if you do 100 Bitcoin clip at a time, pretty quickly you're going to get into $1 million positions, and that did not pose a problem on the 13th. That being said, the spreads were much wider than normal. Mm-hmm. You're talking, if a trade was going to be at a spread of 5 basis points, suddenly it was a spread of 30, 40, 50 basis points. That's just where the market was. You look at some exchanges, the spread to trade 100 Bitcoin was several percent, which is really something we haven't seen.
Which brings us back to the Haslion days of 2017, when you could drive a truck through spreads and everyone was making money hand over fist, the circles of the world at the time. And then 2018 obviously saw a continuation of spread compression and the rise of electronic. So it's obviously a good time to be a firm like B2C2. Volumes are high, spreads are widening. Have they come down since 12/13?
Yes, they have, very much. Yeah, they're more or less back to normal now.
More or less back to normal.
You're talking maybe it might be 20% higher than the baseline would be. So there's still a little bit of room to come back. Now the big question is, are they going to come back immediately? Because it's possible that some people gave up in the market, and that can have an impact on competitiveness. Usually that's pretty short-lived, because if there's an opportunity, someone's going to come in and close it. But I have a feeling that at least at on a short-term horizon, there's the fact that some people dropped off for a few days or a few weeks and they're reassessing what they're going to do. I think that's had an impact on competitiveness, which is possibly going to last another couple of weeks, and then it's going to be back to normal.
Mm-hmm. Are you seeing folks on the trading side step back, as well as are you seeing a shaking out of hedge funds? I know a lot of your counterparties would be crypto native funds. We obviously, as you alluded to, are reporting on Adaptive. They were forced to close as a result of those liquidations on BitMEX on 12/13. Are we seeing, and you talked about traditional hedge funds not doing so well. Given your perspective as a hub, as this middleman, as you described, what is your sense on the state of the crypto hedge fund market right now?
Well, one major problem is that the biggest venue had a traumatic liquidation event. And because it was the biggest venue, everyone was trading there. And whether they were going to have a long or short position is more or less flipping a coin. So essentially, there's half of the funds that were trading on that platform that shall not be named for now, but probably will be during the podcast, is that they either were short and they potentially made a lot of money, or they were long and they got liquidated, and some of them even had to shut down. And I think that I said flip a coin, and that's what your position is going to be. Actually, I take it back. Probably most of the quantitative firms that would be trading on that platform, there's a very good chance that a lot of them were long for a very simple reason. And that's something that's been highlighted on crypto Twitter recently. When you've got different strategies you can run. Some people just make money predicting the direction of the market, but usually that becomes quite difficult, and people, only a handful of firms can do that and make money when markets become efficient. And then people start looking at second and third order effects. So that's why a lot of firms pivoted to trading options, because you've got some edge there. You've got some profitability that not everything's being competed away. And other firms are going to do relative value strategies. So it's going to be things that we've heard of now for a while. When the futures are trading at a premium, you buy physical Bitcoin, you sell the future, and you capture some risk-free interest rate that can sometimes be at very elevated levels. Some of those strategies can return 10, 15, 20% risk-free per year, or could, at least in 2018, 2019. Well, the problem is that a lot of those strategies are going to be taking advantage of minute discrepancies in the pricing of different instruments. And that's sort of like one of the next frontiers. A lot of the funds have raised money, can't make money predicting the direction of the price. Maybe you make money, doing some carry trades, or maybe you make money doing some relative value trades where, when BitMEX trade at a discount and Deribit's likely higher, then you do a trade between the two. Now, the problem is that those relative value strategies were most likely long on the platform that liquidated everyone, because that platform was trading at a slight discount compared to others. And the more the market moved down, the bigger that discount increased. So what you found is the basic strategy is, if there's a discrepancy that's small, put on a small position. And as the discrepancy grows, you add and you add and you add to your position. So a lot of people were at max position at the very worst possible time, and that's when they got liquidated.
It's interesting, and we've talked about this over Telegram about some of these opportunities that traders are taking advantage of. For instance, the Grayscale premium that we see in their products, having a trader or hedge fund decide that they're going to buy at NAV with the hopes that when they can get out of that position, it will still be at that premium at which they can make a nice profit. It's not necessarily that straightforward, but in addition to that and some of the other ones you're talking about, where are other discrepancies in the market that you've identified?
Well, I think that the major platform that liquidated a lot of positions on the 13th, there's a discrepancy right now because it's trading at a slight discount with respect to the rest of the market, and I think that's because people have identified, or if they had identified it, they did not put a big sort of premium on that. But what happens is that if you're going to be long on the platform that liquidated everyone on the way down, then maybe there's a reason that that's where people got liquidated. There's other platforms where people didn't get liquidated, and sometimes there are structural reasons for that. And here we can talk a little bit about vanilla and inverse futures, or vanilla and inverse perpetual swaps. I'm sure that's something you've covered before. Essentially, when you've got a vanilla future, let's say the CME future, you're going to be depositing dollar collateral, and you're going to trade Bitcoin against the dollar. Your P&L is denominated in US dollars. Quite simple. Now, one of the beautiful and big innovations of crypto, it's a product that existed before, but were very niche, and really that's because of crypto that the stuff took out, is those inverse contracts where you can deposit Bitcoin and you take exposure to the price of Bitcoin with Bitcoin collateral. That the beauty of it is that you don't need a bank account, and especially around year 2015 to 2016, banks were really anti-Bitcoin. It was extremely difficult to have access to banking, and so the idea that you could have a derivative platform where people could trade Bitcoin without actually having to touch the banking system, that was a major innovation. And the people that really went all in on that idea, they made it big, and few of them are billionaires now, and good for them. But the problem with the product itself is that there's that it's called wrong way risk when you're long, because when you buy and the contract is for an amount of dollars, as the price goes down, your margin needs to increase in Bitcoin to maintain your position. Let's say you buy $1 million of Bitcoin, so you buy 1 million contracts at a price of 10,000. Then if the price goes to 5,000, your contract is still for $1 million of Bitcoin. But so the size in Bitcoin is double now. And so if you have whatever the percentage requirement is for margin, let's say 10%, then actually you need double the collateral. So not only does the market move against you because you're long and so you're experiencing a loss, but on top of that, your collateral is worth less in terms of dollars, and that triggers liquidations much faster than would be the case when you're using vanilla futures. And so historically, there hasn't really been a difference between vanilla futures and inverse futures. I mean, there's been some, but it hasn't really been, right in your face. But in the past week, the discount has been quite significant, and I think that's a result of that. People have started pricing differently the bad gamma that you get when you're long an inverse product.
What we saw, at the beginning of the year, a number of new derivative products come to market at a pretty fast clip. Everybody wants to get a piece of that pie. And then there's been debates, and Arthur Hayes has weighed in on the effectiveness of using some of these products, options specifically, as a hedging mechanism versus some of these more Delta One products. Just thinking more broadly about the derivatives market as it develops and unfolds, which products out there do you think are the most effective, and which ones haven't come to market that you'd like to see?
Well, Arthur Hayes of BitMEX, there they are. It's BitMEX. I think he's actually quite right. He's a smart guy, and I think his blog post was sensible. The idea being that if you've got a very highly leveraged product that is non-recourse, in the sense that you put down 10 Bitcoin, or maybe don't put down 10 Bitcoin, Frank. I know you're a big whale, but maybe you put down 1 Bitcoin.
I put down 100.
And then you can lever it up. And then you can lever it up 100 times. That actually looks a little bit like an option. because if it goes against you, you get liquidated. It doesn't matter that the market moved violently in your direction, well, against you, because you just get liquidated. They take your Bitcoin, and that's it. They can't go after you and say, well, look, your position is really underwater. You need to pay us more. So that payoff, if you use very high leverage, actually starts to look a little bit like an option, because it's a payoff where you risk some sort of premium. That's your 1 Bitcoin. And if you're right, you make it big because you're at 100x leverage. And if you lose, well, you can only use your 1 Bitcoin. Mm-hmm. In normal circumstances, you would never think of trading a future as an option, because first of all, they're going to come after you. If you're a trader on the CME and you lose a lot of money on your position, they're going to issue a margin call. It's not like you can only use what you've deposited, or depends on the exact contract that you have, etc. And some regulations are different, depends. But basically, you would think that if you're long and you lose a lot of money, you have to pony up and you have to support the loss. So he's right in the sense that a very highly levered futures contract with no recourse beyond the collateral looks a little bit like an option. But I do think that there's some strategies that cannot be expressed without actual options. And that's why that market is developing, because there's some people want to express views that can only really be properly expressed via option strategies. So that's one of the things that it's going to grow. Now the problem is, are we going to see retail options? Because it's obviously difficult to offer options to a retail user base if you want to do it, dotting the I's and crossing the T's. Mm-hmm. Is that product going to take off, considering that retail has got plenty of leverage in the Delta One products today? Are institutions going to want to get in and trade option strategies? I would personally think that we first need institutions to be comfortable trading physical Bitcoin before they're going to start trading options on Bitcoin. I mean, of course, you're going to have some, Bitcoin options on the CME. There's going to be some conventional hedge funds that are going to trade them. But, is that going to be mainstream? I think we need to see more adoption of actual physical Bitcoin trading by institutions before they actually start trading option strategies. That sounds natural to me. And when you look further to other derivatives, well, the fact that there's a very liquid spot market now makes option strategies possible. So some of our clients, for instance, they're options traders, and as you know, when you trade options, you've got delta that you need to manage, and so they trade a delta risk with us. So it's great, if they're long a call, then when the market goes up, they're going to be selling Bitcoin. When it goes back down, they're going to be buying Bitcoin. They're going to trade that delta that moves around with their based on their gamma profile. And so the fact that there's a liquid market for the spot makes options strategies possible. When you have options, vanilla options, you can build more complex strategies, and you're going to be thinking of exotics. I know some people have looked at variance swaps.
There are some people working on variance swaps,
like a swap on the volatility. I think that's can be quite a dangerous product. You need to know what you're doing. There's people have been thinking of other more exotic stuff like mining swaps. Can you have a swap on the hash rate of the Bitcoin network? That's something that's interesting. You could think of interest rate swaps as well, but the first thing that you need to do is to sort of define an interest rate in the crypto market that you can.
I think
BitMEX
is working on that. I think BitMEX is working on swaps, interest rate swaps tied to Bitcoin. They were exploring that product. It's interesting. It's definitely heating up pretty quickly. I guess the one other thing I'd want to chat with you about, get your perspective on, considering how hot of a topic it's been, and Larry Cermak certainly has been following this ad nauseum, much to the dismay of many Bitcoin bulls out there. The fact that it's showing record correlation equities, right? And there are different windows you can look at this at, longer term windows, shorter term windows. But at the end of the day, we've seen Bitcoin underperform the S&P and the price of gold. And at the same time, its correlation to the index has reached yearly highs in March amid this crisis. Does this market environment suggest that Bitcoin might not be as much of a hedge and as much as an uncorrelated asset as some might have thought?
I have two things to say on that. First, I think that the uncorrelated asset argument was always a little bit silly, because people tried to convince asset managers to trade Bitcoin because it was uncorrelated. And that's great. But if you add an uncorrelated asset to a portfolio, it only works if the asset has a return that's high enough to improve your actual portfolio. You know, it's like if I give you an asset that for sure loses 100% of its value in a year's time, for sure. It's like it's got a shelf life. So today it's worth 1, in a year's time it's going to be worth 0. That asset is probably going to be uncorrelated to anything that you've seen, yet the return is minus 100% over a 1-year horizon. So now you've got an uncorrelated asset, but would you add it to your portfolio? No way, you would not, right? So I think when people think of uncorrelated assets, what really they mean is an uncorrelated asset that's got a return that improves your portfolio, and that's not necessarily the case, right? I mean, it doesn't have to be. It turns out that Bitcoin has been on a, it's gone from 0 to 15,000 plus, or in the span of a decade, and it's enjoyed record returns. But the past returns don't mean that, necessarily speaking, in all states of the world, Bitcoin's going to have high returns and low correlation. So you can't accept just the fact that an uncorrelated asset in and of itself is valuable. That argument is just dumb. So I think it's been pretty much debunked now. Mm-hmm. Now there's the second part, which is, well, no, actually Bitcoin is a correlated asset, but it's actually anti-correlated to risk assets. It's an asset that's going to perform when shit hits the fan, and that's something that speaks to me, because I'm a bit of a perma bear, and I'm also a bit of a prepper, and I'm quite a pessimist. So obviously, I missed out on a big portion of the massive equity rally of the past couple of years, but at the same time, I'm feeling pretty smart right now. When you look at Bitcoin, I think that historically it was quite a safe haven asset, but that it's lost that characteristic since the 2017 boom, when there was a big wave of retail adoption and people have just started buying it because it was going up. I remember one of those events, I don't remember the exact days, but I think one of them was 2013, and the other one may have been 2015. One of them was when Cyprus was under pressure, and there were bank failures in Cyprus, and some of the depositors, I don't remember the name of the bank, were bailed in, meaning that normally when you put your money at a bank, there's a government warranty on it up to some amount, and it's safe. But in Cyprus, a lot of Russian wealthy individuals had money parked there, and the bank essentially said, well, we're not gonna pay back your money, and the government scheme was too small to cover the difference. So what happened was that people started freaking out and thinking that in other countries in Europe, in Greece, in Italy, maybe even in France, there was a risk of a bank default where the depositors were not going to be made whole. And at that time, Bitcoin was on a tear. People started thinking, well, holy shit, my money's not safe in the bank. I'm going to buy Bitcoin. So that was quite good for the narrative. And the other one was when, crisis has been on a sort of permanent bailout for years now. And I think it was in 2015, there was, a bit of a scare that their debt to GDP ratio was not improving, that, a very hard left-wing government was going to seize power. And Bitcoin also had, a bit of a rally then. I think those were very positive events for Bitcoin. But the problem is that since 2017, those events have not been supportive of the price. You think of something like the crisis in Venezuela, maybe, I don't know, the election of some, more authoritarian figures in some EM countries, the big market meltdown that we had this month. Mm-hmm. Those events really should have pushed the price of Bitcoin higher. But what you find instead is that now that people actually have integrated Bitcoin in their portfolio, a lot of people have, Bitcoin is 5% of their wealth or something like that. When shit hits the fan, they need to make ends meet, and they're going to be selling some assets. And we saw that they were selling Bitcoin. There's even people that venture to say that in order to meet margin calls on real conventional assets, people have been selling Bitcoin to meet those margin calls, which is, I think, it's completely crazy. You'd think the opposite, right? But it goes to show that now Bitcoin is, maybe because of adoption, actually, it trades more like a risk asset. And that's, I don't think that's very good for Bitcoin. We have to hope that it's just temporary, that it's just because there was a big meltdown. But in the next couple months, perhaps with more money printing by central banks globally, what we're going to see is that inflation might pick up finally, although it's not picked up in years, and that's going to push people to actually look to Bitcoin to be an inflation hedge. But we can't say that's been the case this month, and I think that's very problematic. We need things to change if we're going to be restoring confidence in Bitcoin as a safe haven asset.
And we'll be watching, and we will see if a pickup in inflation does help Bitcoin. That would be an interesting story and might help be a nice reprieve for a lot of the safe haven advocates out there, many of whom read the block, sometimes annoyed, especially with Larry. I don't know if he's watching or not, but I just have to make fun of him. It's what gets me through the day. Anyway, Max, I'm glad you're in good health. I'm glad you're all prepped and bunkered down, and appreciate your insights and thoughts as we all weather this storm together. So take it easy, and we'll talk soon.
Thank you very much.
Thank you,
Frank. Have a good day.
You too.